I'm Isaac Barker from Overcome Mortgages. If you're considering moving home but love your current mortgage deal, you might be able to take it with you. This process is called porting. It can be a smart way to keep your current interest rate and avoid hefty early repayment charges, but it's not always straightforward. And there are some important details you should know before you commit. So, as a mortgage broker, I know all about it, so let's get into it. So what is porting? So porting is the transfer of your existing mortgage interest rate, your outstanding balance and your term from your current property to a new one. So instead of paying off your mortgage in full and taking out a brand new deal, you port your current interest rate and terms. Of course, this is always subject to your lender's approval and affordability checks. So in terms of early repayment charges and refunds, so normally when you repay a mortgage before the end of its product period, lenders charge an early repayment charge. So porting can help you avoid the charge. So if you port the full balance or even borrow more, the early repayment charge you pay when redeeming the old mortgage is usually refunded once the new mortgage completes. But if you take a smaller loan than your current balance, you may still pay an early repayment charge on the portion you're repaying early, and that part is not usually refunded. So, for example, if you owed, say, £200,000 but only need 150,000 on the new property, you may pay an early repayment charge on the 50,000 you're not carrying over. So, in terms of if you're borrowing additional funds, if your new property costs more and you need to borrow beyond your existing balance, the extra amount will be on one of your lender's current products. So that means the additional borrowing may have a different interest rate and term to existing deal. You could end up with two sub-accounts on your mortgage, each with its own end date and rate. So this can make remortgaging in the future more challenging. You might face an early repayment charge on one part, while the other is early repayment charge free. That can keep you stuck with your existing lender. The early repayment charge is costly, and in most cases, any additional borrowing can't extend beyond your existing mortgage term. So, in terms of timescales and deadlines reporting, most lenders require you to complete the mortgage within a set period after redeeming the old one. So, typically, that's within 3 months. If you don't complete within this window, you may lose the right to port your old product, and you could be left in paying the early repayment charge without a refund. So some lenders may allow you to extend the porting window, but you'll need to check. So from my experience, using a mortgage broker rather than going direct to your lender can help avoid delays. So especially when appointment wait times are long. So in terms of some of the key takeaways, porting lets you transfer your current mortgage rate, balance and term to a new property, subject to lender approval and affordability checks. Full balance ports often get the early repayment charge refunded, but downsizing may trigger non-refundable early repayment charges on the repaid portion. Any amount above your current balance goes on a new product with its own rate and term, and this can complicate future remortgaging. Additional borrowing usually can't extend beyond your existing mortgage term, and most lenders have a porting window of 3 months from redemption. Miss that window and you could lose the deal and pay the early repayment charge. So always check with your lender or broker to see if there's flexibility. So that's porting your mortgage overcome.